if you look at back in December, the consensus trade in the market was everyone was super positive on US and super negative on Europe. And that trade has turned totally upside down. Now when I talk to investors, even the US investors want to know what are the avenues to invest in Europe. So there is a lot of optimism coming over Europe. And the reason is very simple. After many, many years, Europe is finally waking up to the need of fiscal spending. Now, whether it be infrastructure or defense, but the fact is, Europe needs to spend. And we are talking of next 5 to 10 years, about €1 trillion will be spent on infrastructure and defense. It's a lot of money, which is positive for growth, it's positive for sentiment.
It is positive for growth, it is positive for sentiment. What about it being positive for investment decisions?
So it's definitely positive for investment decisions, at least in certain sectors. So when I say certain sectors, defense is the obvious choice because you have so much money that needs to be spent on defense. And of course, we can argue that it is because of pressure from Trump that Europe needs to increase defense spending. It needs to become self-reliant. If you look at infrastructure, again, it's positive because you have so much construction effort that needs to be done. Part of it is Ukraine rebuilding, but part of it is just European infrastructure. So investment in infrastructure is a positive. Then you look at sectors like financials, again, it's a positive because if you have got €1 trillion floating around, the money has to flow through the financial system. So there are a lot of sectors where it is positive from an investment perspective as well.
But that's the whole point, Mohit. We were talking about, how tariff proofing is the new buzzword, new buzz phrase doing the rounds about businesses trying to tariff proof themselves. But can they really in this environment? Because, and I know that you're looking at this as an economist, but from your lens, do you really think that countries, regions, companies can circumvent tariffs if they're across the board?
So it depends. Again, it depends on what tariffs we are talking about and to what extent tariffs we are talking about. So let's say my base case is we could get 10% tariffs across the board in Europe. Not 20%, but 10% is very much possible. If you put some numbers, that potentially reduces European growth by around 0.2% for this year. If you think about what fiscal expenditure is going to do, that probably adds 0.2 to 0.3% growth for this year. So what I would argue is that at least when we are talking about 2025, the fiscal stimulus kind of negates the tariff impact. Now, the tariff impact reduces over time because I'm assuming that you don't keep on putting new tariffs every year. But the fiscal spending impact actually increases over time because we have more money being spent in 2026, 2027. So the question to me is, does the new picture changes structurally European growth? Probably not so much. To put some numbers, yes, we are talking of 0.2 to 0.3% growth for this year, potentially a little bit more for next year. But we are still going to grow around 1 to 1.5% in Europe over, let's say, the next 3 to 5 years. If I compare that to US, which is growing at 2 to 2.5% over the same time frame, Europe is still lagging behind. But to me, what matters is, from a market's perspective, is what was the expectations back in December? What is the expectation today? When I see that change, expectations for US have gone down, expectations for Europe have gone up, which means that from an investor perspective, whether it be the equity markets or investments, you are thinking about Europe as a viable destination for investments.